Wait, hold on. I'm sorry. I got to get the right thing so I can see. Okay, 3, 2. Oh shit! Oh, my glasses too. Hold on. All right, here we go. 3, 2.
Okay.
There we go. 3, 2. Hey traders, this is Blake Morrow with Trader Summit. I have Mr. Jim Welsh from Macro Tides with us. It is Friday, and it's so good to see you, Jim. How are things?
Everything is good. It's Friday of a short week. Next week is going to feel like a really long week, but we'll take this week as it is.
Yeah, and we got a shortened week, and we started to see the S&P show some signs of weakness.
Yep.
What are your thoughts about the price action around these levels?
Well, my thought, in the weekly technical review that went out earlier this week, my expectation was we were set up for a pullback in the S&P 3850, maybe even a touch lower than that. It could cut a little bit deeper. And again, I have believed that the FOMC and all its members would continue with their very, very clear messaging that the funds rate's going to go up a bit more. And more importantly, they're going to hold it at that level. They're planning to hold it for all of 2023. And I just think that the markets all the markets haven't totally accepted that. And we also got some weaker economic data, which in the short run is not going to dissuade the Fed from the course they're on. And the market finally did respond to, oh, wait a second, the economy maybe really is slowing. So I think a lot happened this week just in terms of slowly but surely moving toward that point in time. I still believe there's a recession coming, more likely as we get towards mid-year. And as we get closer to that mid-year time, the economic data is going to show, if you will, more evidence that, wait a second, this thing is slowing. And, all it takes is some weak data points, Blake, where people are like, well, if we do have a recession, it's going to be soft. Yeah. Well, at some point in time, the risk is you get data points that make people, whoa, maybe it's not going to be soft. That's what I think is coming, but we still might be 2-3 months away from that.
Okay, well, given 2-3 months of bliss, then I'm going to assume that that's what you think. We have we're about a week and a half away from the Fed meeting and giving us it seems like what's going to happen is we're going to raise rates, or they're going to raise rates by a 0.25%, maybe another 25 basis points. But you have a chart here that says that the Fed's going to be fairly restrictive. What are your thoughts behind this graphic here?
Yeah, basically what this shows is the Taylor rule that St. Louis Fed President Buller has talked about. Excuse me. And basically the assumption and why you have that range above the actual funds rate is based on, if you have, very positive inflation outcome versus not as positive. And, but you can see 17 of the 19 members at the December meeting said they expect the funds rate to go to 5% or higher. The median was 5.1. We're at basically 4.25 to a half. So, everyone's assuming a 25 basis point hike. But what the Fed has shown is a willingness over the last 9 months to get to where they think they should get to more quickly. Remember, no one was looking for successive rate hikes back last spring. I did, because of what Powell had said last January with inflation being a severe threat. But then the Fed said, now we're going to get to neutral. They used 0.75 point increases to get to neutral, then beyond. So I think the jury is still out, whether they're going to go 50 or 25 at the February 1st meeting. They've shown this propensity, Blake, to want to get there sooner. And I think that may happen. So I think the markets now are set up anticipating, we're only going to get a 25. And, the reality is, okay, you get to 25 and they talk hawkish, which again, I think the Fed will. One of the points we've talked about the last 2-3 weeks is financial conditions have eased significantly. The dollar's down, treasury yields are down, stock prices are up. I think they want to push back against that, because to really get the economy slow, you need financial conditions to remain tight. And so, again, I think they're going to remain pretty hawkish.
Okay, well, if you think they're going to remain hawkish, is it as a result of maybe what this service inflation is showing us at this point?
Yeah, that's one of the reasons. I mean, Powell basically has said we're looking at service inflation. Most of that's related to the tight labor market. But obviously they go hand in hand. And what we can see is, yes, headline inflation is coming down predominantly because we've seen a very significant decline in energy prices and some relief in some of the other things like used car prices and so forth. But service inflation is still very stiff. And again, this is why I think the street is misreading the Fed, that they're going to hold the funds rate at a high level. They call it restrictive level for all of this year. And this would be one of the justifications in terms of going 50 instead of 25. Nonetheless, what that first chart shows, I think, is their resolve to get up towards 5.1. And I think they'd be wise almost to do 50 at the February meeting and then maybe the 25 at the March meeting, but we'll see. This is a causal concern.
Well, that would hurt the market. So I'd love to see, your view of the markets here, because if the Fed does raise by 0.5%, the markets are not going to like that.
Yeah, they're not. And again, you might get a quarter point. Oh, gee, we got what we expected, but we're still getting a lot of hawkishness and resolve out of the Fed. So you get what you want, but you didn't really get a full sandwich. You got a bite, but not the whole enchilada. Yeah. What this chart shows, the bottom part is this is a 2-hour chart. So it shows that short term, we're oversold. We're due a bounce. I think we're going to get it. But I think after any bounce, the odds we're going to see more weakness. And the next chart shows why. So, this is a short-term 2-hour chart. This is a daily chart. And what it shows is an oscillator based on market breadth, advances minus declines over 21-day window of time. And you can see when this thing gets above the red line, you're near a high. And conversely, you need to get somewhat oversold. And we're just coming off of a very high overbought reading. So I think we're going to see more weakness, Blake. In other words, you relieve the short-term oversold pressure on prices with a bounce. But intermediate term, you still need, I think, some more price weakness and a deeper pullback in order to set the stage for the next pop. So my expectation is, I would think, at a minimum, we'll test 37.64. I think there's a reasonable probability that we'll take that out. And maybe it's in conjunction, ironically, with the Fed meeting, where they give the markets whatever they're thinking for, but at the same time still retain that hawkish message. And obviously, if they do 50, that would be a stumbling block for the market. So I think the market's had a nice little bounce, but I think the upside is rather limited based on the intermediate oversold condition that exists.
Got it. Okay. Well, you bring in a chart of gold, and gold surprised me this week by lurching to new, or lunging, however you want to look at it, to new highs. Yesterday, new trend highs anyway. Is this a top? I mean, should we really label that in a one? I mean,
well, again, my outlook was that we would get a rally to 1750, 1800-ish. And then that would set the stage for a decline back down below 1616. So I was bullish when we were at 1630, looking for 1750, 1770. We got that move. And then obviously it's continued. One of the things, and I think we'll look at that next, is the dollar chart. The dollar has kind of been the key to all the markets. It made its top in October. Well, when did treasury yields top? October. When did gold bottom? October. When did the stock market bottom? October. And my view is the dollar is close to another fairly decent trading low. So, my thought here, Blake, is that the extent of this move, the strength of this move, suggests that we may have begun the move to higher highs, all-time highs on gold. I thought we were going to get a drop below 1660 after this bounce, that bounce to 1750 to 1800 that I referenced. Yeah. Then, below 1660, and then the big move. I think potentially wave 5 bottomed in that October timeframe, even though gold didn't make a actual price new low. It missed it by about $1.50. But the strength of this suggests that I have to be open to the idea that, hey, maybe that move to new all-time highs in gold has already begun. That said, I think gold is near a high, very overbought, as you can see on the RSI, over 70. And if I'm right about the dollar making some kind of a trend line or a bottom here from a trend standpoint, gold, I think, is going to pull back. So, the last 60, 70 bucks on gold has surprised me, but it doesn't, it's good longer term because it's showing some longer term strength. But short term, I think this is not a good location to be long. And I would be looking for a pullback. And then if we get an ABC or corrective type of a pullback, that will reinforce this idea that, hey, we've had wave one up, we're getting a wave two pullback, and then we're going to go above 2100.
Well, that would be something. And I think gold bulls would love to see that. Well, the last chart you brought, Jim, was
I think yield. I sent you a dollar chart, which I think maybe somewhere got lost in the shuffle.
Might have gotten lost in the shuffle, but that's okay. Let's talk about yields.
Okay. Well, if you want to look at the dollar chart, it hasn't changed a whole lot from last week's video that we did. I just think the dollar is completing a decline near the recent lows at 102-ish, long-term trend line 5 down, all the rest of that. So if I'm right about that, as I said a little bit ago, the high in the dollar allowed all the markets to bottom. And I think we're going to see a reversal. The interesting thing, I talk about inter-market divergences. So when you have a market like treasuries or silver and gold is showing all this strength. Silver's not agreeing at all. So you have kind of an intermarket divergence there where one metal's outshining the other. That typically is what happens prior to a pullback. Here we see the 10-year made a lower low, 337 versus 342. It's all centered right around the 50% retracement. The 30-year got down to 345, which was a 618 retracement of the big move up from earlier in 2022. But you can see how it fell way short of making a lower low. So here we've got kind of like, gears in a machine, and all of a sudden they're not working together.
They're not linking up correctly.
Exactly. So historically, when you get these intermarket divergences, it usually is a key sign in terms of, all right, you're about to get a reversal. And I think my guess is that the 10-year can make a move up to 380, 390. The 30-year can go back up and potentially test that 399. So again, to me, technically, this implies that yields are going to head higher. And the key, unfortunately, I think will be part of it is the dollar. And then all the markets, have taken this view that the Fed isn't going to do what it says it's going to do. They're going to bring rates down the second half of this year. I mean, they're still looking for, and based on the Fed funds, it will peak at 487. And by next year, we'll be down 150 basis points. It'll be down 50 basis points in the back half of 2023. And maybe that will happen. But in the short run, I think the Fed is going to continue to push very hard against that notion. And sooner or later, like we saw, Powell gave a speech at Jackson Hole in August. Whoa, these guys aren't kidding. I think there's that moment coming when the markets realize that these guys are going to do what they're talking about. That should be positive for the dollar strength, and then bleeds weakness into all the other markets.
And it does seem like that the market's trying to play chicken with the and calling the Fed's bluff. And I think the next 2 weeks are going to be really interesting. I know next week we got some PMI data coming out and some kind of ancillary data. We've gone into the what is the blackout period for the Fed. So we're not going to hear. So
we're not going to get the Fed talk, which every day this week it was the same message over and over and over again. Maybe that can be somewhat helpful for the markets. I think earnings are going to be on balance okay. The Atlanta Fed GDP now has fourth quarter GDP at 3.5. I think, as I mentioned last week, maybe it's 2.5. But on balance, the fourth quarter wasn't all that terrible. Retail sales came in weaker, but part of that, Blake, is that the year before, remember, there were shortages. People didn't get Christmas presents in time. Plus, the retailers had a lot of inventory, as we well know, and there was a lot more discounting in October and November, and purchases for Christmas got pushed in. So I think some of the retail sales definitely reflect some fatigue on consumers' part, but I think got magnified based on these other factors.
All right, Jim. Well, I love you taking us through the markets each and every week. And I know if you're at home and you love listening to Jim, make sure you jump in the comments. Give him some comments, anything that you feel that he should be focused on, or maybe some questions you might have for him. Give him a thumbs up too. Make sure you subscribe to the channel. But Jim, how do I follow your work closer? How do I get my hands on this technical review you keep talking about?
Well, you can always send me an email, jimwelshmacro@gmail, and I'll be happy to send you last week's issue out. Macrotides.com. You look at the website, get some additional information there. My focus, as you know, over the last year especially, is monetary policy. And I think the analysis that we have provided over the last year has been really spot on relative to what people have been getting from Wall Street, CNBC, and so forth. So I feel very good about what we've been doing here, Blake. And I urge people to, continue to tune in. And more importantly, subscribe
and and share the love. If you see this on social media, make sure you share it on LinkedIn or Twitter or whatever, Facebook, whatever you're seeing us on. All right, Jim, I want to thank you for spending your time with us this week. I'll look forward to catching up with you next week, just ahead of the Fed. Have a great weekend.
You do the same, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.